Even as many of the large foreign brokerages hail India's mid-cap and small-cap story, washing deals like the one Strides did, there are brokerages like Morgan Stanley that have consistently remained bearish on the India story. And one such example came in from the head of emerging markets out of Europe, who was visiting India today. Incidentally, at a mid-cap conference, said that it's time to look at India much more underweight and also keep it less attractive than countries like Taiwan, Korea and even Russia and Brazil.
No one knows why Morgan Stanley has been so bearish on India. What is known is that they've been proved wrong a number of times, ever since the bull run started in 2003. And even now, the head of emerging markets at Morgan Stanley, Jonathan Garner, says the bull run is just about to end when everyone else is putting aggressive targets.
The valuations on this market are significantly higher than the average in emerging markets, trading on about 22 times next year's earnings compared to 15 times for the average emerging markets. So we tend to see a better value in fact elsewhere.
While Morgan Stanley believes that banking, infrastructure and even capital goods sectors are now expensive and IT is at risk, it's the big daddies of telecom, energy and steel that look attractive to the company. Morgan Stanley has increased the chance of the US going into recession to 40% next year, compared with the 20% chance the company quoted a few months ago. But it's not just global markets, it's also the Indian domestic overheating that bothers the emerging market strategist at Morgan Stanley.
The domestic economy here has been contending with overheating. We have had issues on inflation here, the central bank's been tightening monetary policy, and it may be that next year is a slower growth year because of that domestic cycle in India.
Jonathan Garner is convinced the world economy still hasn't borne the brunt of a credit crunch that is yet to unfold, not to mention the threat of oil prices. But the economist says oil prices can only rise so far.
And we wouldn't really be looking at significant shortfalls in demand in the OECD until we're hitting $115, $120 a barrel. But that said, I think clearly we're in a situation where we're nearer to the end of the oil cycle than we are to the beginning. And so therefore it's not necessarily the case that the outlook is as positive for oil as it was 1 or 3 years ago.
A predictably bearish outlook from Morgan Stanley on India. It is tough to foresee when a 4-year bull run is going to come to an end. But the markets have exhibited a nervousness over the last 1 month. And that's what foreign and domestic investors are watching closely. In Mumbai, Devna Bora for NDTV.